Hello, my name is Camila Cañon and I am here to represent Angola by explaining point 4 of the second workshop. We will begin with part A, which asks us to find the risk premium for your country and compare it with that of its main trading partners. Okay, in this point, we will see the risk of our country and the comparison with our partners. We can see the graph. Even though the risk is high, Angola is emerging as one of the most attractive destinations for investment in the oil gas sector, particularly in production and exploration. This African nation has long been known for its abundance of natural resources, but what really sets it apart today is its combination of high profitability indicators and a favorable fiscal environment. While mature markets such as the United States and Europe continue to offer stability, Angola is catching the attention of investors for a different reason: its superior returns on equity and the opportunity to capture higher net gains. Okay, continue with point B, Angola versus mature economies, which says which says to look for betas with and without leverage by industry in your country and compare them with main trending partners. We can see the graph in mature economy. We often see the same story: strong institutional frameworks, high levels of regulations, but lower returns for investors. In the United States and Europe, the burden of corporate taxation and other fiscal obligations reduce net profitability. Angola, on the other hand, presents the opposite dynamic. Companies in the oil gas sector report and return on equity that surpasses those of developed economies. For investors, this means that capital is not only preserved but has potential to generate much stronger returns. We can see in the second graph that the betas are very high, which means that it is a high risk investment market, making it very volatile and sensitive to change in the global market. Okay, now Angola continues to outperform India, and although China also has high risk, its CPR allows for low cost financing. On the other hand, Angola is more unstable when using these debts, which increase its cost of capital. Okay, now with the point C, competitive advantage over Asian giants. In the graph, when compared with large emerging economies like India and China, Angola reveals a particularly interesting profile. Its marginal corporate tax rate is only 25%, significantly lower than many other markets. This relatively light tax burden makes Angola especially competitive. Investors can retain more of their profits, and this combined with the country's resources will create a powerful value proposition. Now continue with the point D, balancing risk and reward. Of course, here we cannot overlook the fact that Angola carries a higher country risk. Its beta values are higher than those of its main trading partners, which indicates greater volatility. But this is pres- but this is special where Angola becomes a strategic option for investors with an appetite for diversification. The risk return balance is appealing. The promise of higher profitability coupled with a super fiscal environment often outweighs the concerns about volatility, particularly for those seeking opportunities in emerging markets. And finally, with the point E, Angola global relevance. Let's not forget Angola's historical and ongoing role in the global energy supply chain. The country has long been a major supplier of crude oil to energy. Hungry economies like China and India, in a world that is constantly seeking reliable source of energy. This makes Angola not only relevant but indispensable. As global demand for energy continues, Angola established position strengthens its role as a trustworthy supplier and increase the attractivity of investing in the oil and gas industry. Okay, in conclusion and closing an investor takeaway. So the main important question is, what does this mean for investors? Investing in oil and gas production and exploration in Angola means accessing mm, high returns on equity compared to developed markets, lower tax rates that directly boost profitability, abundant natural resources that secure long-term supply potential, and yes, the risks are real, but the opportunities are even greater for those willing to take a step into emerging market. Angola offers not just another option, but a strategic opportunity, a chance to balance higher risk with potentially extraordinary rewards in the global energy landscape. Now, about the point 6 in the first graph, the production possibilities frontier of Norway and Sweden. It represents of the vertical axis we have fish and on the horizontal axis cards. Norway, due to its geographical location and its long coast on the North Atlantic, is relatively more productive in fishing. In contrast, Sweden, with a greater endowment of capital, is more productive in automobiles. This generates comparative advantage. Norway exports fish and Sweden exports cards. With trade, each country produces what it is more efficient and consumes more of both goods than in autarky. The points marked in the graph are the new consumption points after trade, which lie outside the initial PPF, thus showing the gains from trade. In the second situation, the problem of overfishing in Norway is introduced. This reduces its productive capacity for fish, meaning its PPF construct on the vertical axis. At the same time, scarcity raises the world relative price of fishing. It has two possible effects on Norway's welfare. First, by exporting a smaller quantity, its export income may fall, reducing its capacity to import other goods, and therefore lowering its welfare. But second, if the price of fish rises enough, may earn more income per unit export, offsetting the decline in quantity and increasing its purchasing power. In that case, could even improve. In the third graph, an extreme case is analyzed relative supply in unresponsive to prices, meaning productive factors are completely immobile between sectors. In this scenario, production does not shift even if relative prices change. However, the country can still adjust its consumption and lock the trend line according to the new terms of trade. Thus, even its production remains fixed, welfare may increase or decrease, due to price change and the resulting consumption patterns. In the graph, the lines with different slopes represent this change. In international prices and the different consumption combination the country can achieve. Finally, in the fourth graph, The absence of substitution in demand is present, meaning consumers purchase the two goods in fixed proportions. This is a relative type case. Here, if the terms of trade improve, for example, if the price of the export goods rise although consumption's proportion do not change, real income does increase, and the country can consume larger amounts of goods in the same proportion. Thanks to this, welfare rises in the graph several step shape in different curves can be seen. As the terms of trade improve, the country moves to a higher indifference curve. As a conclusion, this exercise shows how comparative advantage allow both countries to gain from trade, but also how factors such as resource sustainability, factor mobility, and consumption preference can change the impact on each country welfare. Thank you for your attention.